Hello and welcome to my June economic and RBA update. It is another huge month of data. We've got so much to cover off on. I'm going to be focusing on the US avoiding its loan default, the RBA making a tough call on interest rates. We're going to go to a deeper dive in the Australian economy, looking at wage growth versus productivity and the battle between that and how it affects inflation. I'm also going to share some news for anyone who's stuck in mortgage prison, so hang around for that. There's an important update there. And I'm also going to be focusing in on the property update. So I'm going to put forward my views on why property prices are growing and why they're growing even faster than I expected them to grow. So we really do have a huge show here today, so let's get straight into it. Okay, I want to talk about the US first. And as I mentioned in the intro, the big news out of the US was centered around the US Congress approving an extension to the US debt ceiling. Now, whilst the debt ceiling has been used as a political football between the Democrats and the Republican parties, last week the US Senate passed the bill to ensure the US didn't miss its repayments on its financial debts. If it did miss, we would have triggered effectively a loan default, and the consequences of which would have had a potentially large cause to a major global financial markets meltdown. Anyway, they got it done at the 11th hour, and so the meltdown was avoided for now. Now, as a result, investors in the US and around the world breathed a sigh of collective relief as the US equity markets went on a predictable mini rally. And then we also saw other good news coming out of the US as well in terms of sentiment changes around that. So let's do a quick summary around the major points of the deal. And sorry to bore some of you, but here we go. The debt ceiling currently stands at $31.4 trillion. The deal suspends this ceiling until January 2025, beyond the current term of the US President Biden and the next presidential election. Now, key spending changes included non-military spending to be held roughly flat for this year through to 2024 fiscal year. Increases for the 25 fiscal year to be capped at 1%. Military spending, so they are rising by 3% in the 24 fiscal year, broadly in line with President Biden's budget requests. Now, there's $20 billion shifted from the Internal Revenue Services, the IRS, over 24 and 25 to other areas. This reallocates some of the $80 billion the IRS was granted over the decade to expand its capabilities and hire additional staff to increase tax enforcement activities. Now, there were clawbacks to funding raised for unused COVID-19 support measures. There were increases in work requirements for individuals to receive government food aid support payments. This will be implemented through raising the age of people who must work to receive such payments from 49 years of age to 54 until 2030. Exemptions for certain individuals, such as veterans or homeless people, will be expanded. Now, student loan repayments are to be restarted from the end of their summer after payments were paused during the pandemic. And finally, in terms of climate and energy, clean energy measures for the Inflation Reduction Act will be maintained. Now, this last policy is a smart one, because what they're trying to achieve over there is to get effectively power down to zero. And this is obviously incredibly attractive to attract business investment, create economic activity, jobs, and cheaper living costs for their citizens. So I really do like what they're doing over there in terms of trying to drive energy prices down. And if you're listening, our Australian government, cheaper energy is a competitive advantage for any economy. So we need to do something like that here in Australia. All right, now let's talk the inflation story over in the US at the moment. And we saw that the annual inflation rate in the US fell to 4.9% in April, the lowest since April of 2021, and below market forecasts of 5%. Food prices grew at a slower rate of 7.7% versus 8.5% in March, while energy costs fell further, negative 5.1 versus negative 6.4, including gasoline, negative 12.2, and fuel oil, negative 20.2. Also, shelter costs, which account for over 30% of the total CPI basket, slowed for the first time in 2 years, 8.1% versus 8.2%. And prices For used cars and trucks declined once again, negative 6.6 versus 11.6. So there's that evidence of the disinflation happening there when I talk about those negative numbers that we were seeing there. Now, this all sounds pretty good. However, compared to previous month's result, the CPI rose 0.4, much higher than the 0.1 in March, matching market expectations. So shelter was the largest contributor to the monthly all items increase, followed by used cars and trucks and gasoline. So in other closely watched inflation data, the core PCE deflator lifted in April to 4.7% year on year and has stuck in a range of 4.6 to 4.8 for the past 6 months, suggesting some possible stickiness in US inflation. Now remember that the US Fed target range for inflation is 2%, so they still have plenty of work to do. Let's talk interest rates now on the back of that inflation story. And we saw the Fed raise the Fed funds rate by 25 basis points to a range of 5% to 5.25% during its May meeting, making the 10th increase and bringing borrowing costs to their highest level since September of 2007. There is still upside pressure on rates to go higher on the back of this sticky inflation story, and still a very strong labour or jobs market. But how much further this tightening cycle will need to go is coming under increased debate. The Fed Chair, Jerome Powell, continues to communicate that each future call on rates will be informed by the latest data, meaning that each meeting for the time being will be a live meeting. The unemployment story now, and we saw the unemployment rate in the US increase to 3.7% in May 2023, the highest since October of 2022, and above market expectations of a 3.5% increase. Despite this uptick, the jobless rate remained historically low, and as I mentioned, the labour market remains tight. The number of unemployed people increased by 440,000 to 6.1 million, and employment levels declined by 310,000 to 160.72 million. The so-called U6 unemployment rate, which also includes people who want to work but have given up searching and those working part-time because they cannot find full-time employment, rose to 6.7% in May, also above forecasts of a 6.6% increase. The labour force participation rate was unchanged at 62.6%, remaining at its highest level since March of 2020. Consumer sentiment now in the University of Michigan's consumer sentiment for the US was revised higher at 59.2 in May from the initial estimate of 57.7, but remaining the lowest level in 6 months amid worries about the path of the economy and whether it will fall into recession if rates stay higher for longer. Now let's round out the US data update to take a look at some of the business data, and we saw the ISM manufacturing PMI fell to 46.9 in May from a 47.1 reading in April, compared to forecasts of a 47% even reading. Now the reading indicates the 7th consecutive month of contraction in the manufacturing sector, as companies attempt to manage outputs to better align with fluctuating demand. Right now, business sentiment and uncertainty remain elevated as new orders, 42.6 versus 45.7, inventories, 45.8 versus 46.3, and backlogs of orders, 37.5 versus 43.1, contracted again. Now remember, expansion is above 50 and below 50 is a contraction. On the other hand, we saw production rebound with a reading of 51.1 versus 48.9, and employment rose at a faster pace of 51.4 versus 50.2. So some real mixed news in terms of that data between, say, the reading that we saw in May versus April. So let's summarise the US right now, and their economy is still growing slowly as they get used to a higher interest rate environment. And their challenges is no different to other developed nations in terms of how they manage the inflation back to its target range. That's going to play a big role in terms of how their economy performs over the next 6 to 12 months. Now, usually I move on to China here now, but there really hasn't been any significant data being reported out of China. So I'm going to skip China with a view of moving this along and obviously making my presentation a little bit shorter this month because there's so much domestic data that I want to cover off on. So let's go to the Eurozone now because that is also a very important economic centre that we want to study. So starting with their inflation story, and we saw the consumer price inflation rate in the Euro area fell to 6.1% in May, down from a reading of 7% in the previous month and below market expectations of a 6.3%, which was their preliminary estimates had shown. Now, this means that the inflation rate hit its lowest level since February of 2022, though it still remains significantly higher than the European Central Bank's target of 2%. The decrease in inflation was primarily driven by a 1.7% decline in energy prices following a 2.4% increase in April. Additionally, there was a slowdown in cost pressures for food, alcohol and tobacco, 12.5% versus 13.5%. Non-energy industrial goods, 5.8% versus 6.2%, and services, 5% versus 5.2%. In further good news, the core inflation rate, which excludes energy, food, alcohol and tobacco, also eased more than anticipating, hitting 5.3%, down from 5.6%. So, given the inflation story, what did the ECB do with interest rates last month? Well, they raised their key interest rates by 25 basis points, taking their cash rate now to 3.75%. Now, this signals a slowing pace in policy changes. That said, borrowing costs have now reached their highest levels since July of 2008, following 7 consecutive rate increases as the ECB tries to combat high inflation despite ongoing recession risks. So, although we saw the ECB move from doing 50 basis points increases to now doing 25 basis points increases, President Lagarde has told the media and markets to expect that they have more ground to cover, and it's not pausing the rate lifting cycle anytime soon, meaning obviously increases in interest rates are coming to the Eurozone. Rounding out the Eurozone data, and we see the unemployment rate now sitting at 6.5%, down from 6.6%. Consumer confidence saw a slight improvement from negative 17.5 to negative 17.4 in May, and business confidence decreased from 0.51 to a reading of 0.19 in May on the back of continued interest rate rises and the slowing economic conditions in the EU. So in summing up the Eurozone, it's more of the same as they try to get the balance right in keeping inflation coming down whilst also trying to avoid slowing economic growth too much. Now, it's a very difficult balancing act for them to be able to pull off with inflation still too high in the region. So it's likely that we'll see a recession in that Eurozone if inflation remains higher. All right, so that rounds off the economic updates around the globe quickly. Now we're going to take more of a deeper dive into the domestic economy. And as we always do, let's focus in on the RBA rate decision. Now, given just how important this decision is for most of us these days, I'm pretty sure that you've already know what the rate decision is. And obviously the anticipation was too much for all of us. So you've probably found out what the call has been. But anyway, I want to share with you how that decision played out and my views and opinions in terms of why they made the decision that they did today. So today we did see the Dr. Lowe and the RBA Board decided to lift the cash rate a further 0.25 basis points, taking the cash rate to a reading of 4.1%. Now, this has taken the cash rate 400 basis points higher since May of last year. Now, that means on a $500,000 mortgage, just looking at the interest costs over a 12-month period have increased $20,000 or $1,667 a month. Now, you can understand how this is starting to now wipe out savings buffers and also starting to reduce discretionary spending, which we'll talk about later on. Now, more on this cash rate challenge shortly, but first of all, I wanted to talk about why did the cash rate move higher when only around 4 weeks or so, many of us expected that the cash rate would remain where it was and wouldn't go any higher based on what the RBA was telling us in terms of what data to look at and what was happening with that particular data. So why did they decide to lift the cash rate? Well, let's summarise the answers now. Number one, the economy is still running too strongly. Demand is still strong enough for businesses to still pass on higher costs, meaning that inflation isn't cooling as quickly as the RBA would like. Number one. Number two, housing rents are growing at double-digit pace, and now house prices are rising quicker than they would also like. And finally, number three, which is the straw that probably broke the camel's back in terms of why they did raise rates today, is that the higher than expected increase in wages could feed into their biggest concern, which is a wage price spiral risk. And so the RBA has been really clear that is what embeds a higher inflation for longer, is this wage price spiral risk. So that is a concern for them. So, especially given that the economy hasn't even seen any productivity gains in several years. And what does that mean in terms of productivity gains? Well, it basically means that labour input costs are rising. That's the wages rising, but we aren't increasing our productivity or output. So the RBA's main concern here is that workers are getting paid more, but producing no more, or even in some cases less. And therefore, this is causing consumers who are still happily spending, businesses are able to then pass on those higher labour costs in their goods and services, leading to, you guessed it, higher inflation. And obviously, what is the RBA trying to prevent? It's this sustained higher inflation. So we've seen that move today in terms of why they're looking at that. So now with every rate increase from here, it's clear that the narrow path that the RBA was trying to walk is getting harder. Now that narrow path was to try to keep the economy growing, try to keep the level of unemployment down, so the number of people who lose their jobs down, and also avoid a recession. And this is getting harder for them to navigate, over the medium term, because of obviously the amount of increases that they have to do to slow the economy down. And so there is going to be some more longer term economic pain for us if these rates continue to either go up or remain higher for a little bit longer than what's anticipated. Now, with all this interest rate talk, it's a perfect time for me to sort of predict the media narrative that we're going to see in terms of this increased media reporting around mortgage stress. Now, we all know that the media love a good fear story. It obviously helps with growing media audience, and unfortunately, it does drive into the narrative of spooking people and creating a bit of that fear. So I'm going to attempt to get in front of this emerging media story and educate you and inform you about what's really going to be happening when it comes to mortgage stress and mortgage arrears increasing significantly in Australia. Now, I'm going to equip you with the data and the facts that you need to help better understand for yourself, and also to help you to tell others in terms of making sure that you stay calm and that there's no panic in the market. Because here are the facts. According to Fitch Rating Agency, the current 30-day mortgage arrears rates is sitting at 0.82 of 1% at the end of 2022. That's right, less than 1%. Now, yes, it is true that arrears will increase because rates are going up so much and they've gone up so quickly, right? So we expect that those arrears levels will increase. However, we want to put them into context, because the media narrative and the headlines won't do that for you. So what we need to understand is that there's 10.9 million dwellings in Australia, and the total value of these dwellings currently sits at around $9.5 trillion, and the total value of debt is $2.2 trillion. So from a loan to value ratio perspective, that's around 23%. Now let's assume that our arrears rates will move above 1% and potentially double. So let's say they move to a 2%. Now that means around 218,000 households will be in 30-day mortgage arrears. Now that sounds like a lot when you're thinking about the 218,000, but in context of 10.9 million homes in the market, these arrears levels are unlikely to be too concentrated to cause any systemic risk. So there really isn't any reason to panic about what we're going to be hearing in this sort of headline stories that are going to come out of the media in terms of mortgage stress, and also mortgage arrears and mortgage in possession and mortgagee sales. All of those things are going to hit the headlines, but we want to keep them into context. Now, it's my goal in terms of this update. I'll make the commitment to you that I'll remain diligent on this area of arrears because it is important. And I will keep you informed in the event that I see any elevated risks in the mortgage space, and obviously in terms of that elevated risk, in terms of how that will flow through more broadly across the property market and ultimately in prices. So that's my commitment to you, to making sure that you understand that, because I wanted to make sure that I wanted to give you this heads up of what's going to happen in the media and that you shouldn't panic. And again, you should be telling your friends to also not panic around this particular story. And of course, I also want to build on this by talking about those households that are experiencing challenges here, and I want to share some important tips in terms of what you can do to avoid the most important message that I have as part of this update. And that message is, do whatever you can to avoid having to sell a property. Okay, that is something that will bode well for you if you can avoid not having to sell a property. So what should you do? I'm going to go through some tips here. Number one, I want you to review your current home loan if you haven't already done that, or your mortgages, if you haven't already done that in the last 12 months. Okay, now there's also some important developments that have happened in the last couple of weeks when it comes to those people who may have spoken to their bank or may have spoken to their mortgage broker in the last couple of months. And that is around the mortgage prison. So based on the servicing calculators, there's nothing you can do, so you can't go to a cheaper loan. Well, there's been some significant developments from a couple of lenders out in the marketplace, whereby if you are looking to refinance only, not buy new, not take out any additional money in excessive amounts, but just to refinance to a better deal, there are some lenders out there who are using an approach that will allow them to reduce the buffer rates and the serviceability rates to allow you to potentially get into a better mortgage. So what should you do? The first thing you should do is contact your broker. Your bank won't probably know about this. There are several already, and I suspect other big banks will follow if more and more market share starts to go to the banks that are offering this special refinancing opportunity. So contact your broker. If you don't have a broker, obviously at Empower Wealth, we would happily help you. Go to our website. You can get a free initial consultation and we can see whether we can help you out there or not. So, but that is only for people who want to refinance to a better deal. Point number one. Point number two, I want you to cut back on all discretionary spending. So if this is about saving property, we need to make sure that we're sacrificing any of that discretionary spending. Also, point number three means you might have to cut back on some essential spending. So you need to look for substitution products, potentially moving away from the expensive grocery items to some of the cheaper items. Again, if this is a necessity for you to do whatever it can to keep your properties. In terms of point number four, take a second job. Earning that additional amount of cash is also going to see you through this short-term period that we're going to be going through to allow you to maintain your property and continue to keep holding it if that is a problem for you. Point number five, it's okay to dip into your emergency savings or your savings buffer. That's exactly why you put it in place for times like this. So if you're experiencing negative cash flow, it's actually okay to see your savings buffers reduce in this period of time. It still means you're retaining all of your assets, which is the story here that I'm trying to drill home. In terms of a next step number 6, sell any discretionary or leisure assets. So if you've got cars or bikes or caravans or boats or anything of some value, try and move those on. Old clothes that you never wear, see if you can sell some of that sort of stuff. Any bit of cash flow that you can add to the household is going to be significant for you. So try and do that. Point number 7 is avoid taking on any more debt. So no more personal loans or credit card. Certainly consolidating high interest debt into a cheaper loan is very much encouraged. But in terms of taking out additional debt, that should be something you want to be very, very mindful of, and you want to be very clear about your cash flows. In terms of point number 8 is about sort of saying to yourself, can you get some short-term family support from loved ones or family members who might be able to see you through this period. And of course, the other big message here is if you are sticking with your current bank and times are tough, talk to them about a repayment plan. The world has changed significantly from where they would automatically put you into arrears and then put pressure on you to sell your properties. These days, they're a lot more accommodative in terms of how they want to look after you, in terms of trying to get through this particular period, and selling of the property should be an absolute last resort. Now, why am I saying that? Because the goal here is really clear. If you are able to retain all of your property assets, it will be financially well worth it, because what we will see is in the long run, rates will start to come back down. And it's very clear in terms of the demand for property at the moment that when interest rates start going down, borrowing power starts to improve, that those property values will start to increase. And we're talking in potentially the tens of thousands and hundreds of thousands of dollars. And so that's what the sacrifice was all about in trying to hold on to those properties. Because I know the feeling when money's going out the door and there's more going out than's coming in, the psychology is difficult. And so that's why I'm stressing this point in this particular update. Right, so, enough of the public announcement messages and the tips. Let's move back into the economic data now. And I want to kick off with the April inflation data story, remembering that the monthly data doesn't deliver us the total basket of good in which we measure for the consumer price index against. So, those monthly reads are a little bit unreliable compared to the quarterly reads. And so what did we see in the April data was a mixed inflation signals and story. So the monthly consumer price index indicator rose 6.8% over the year to April from a 6.3% reading in March. Now the ABS, which releases this data, made notes that significant contributor to the increase was the fuel excise cut, which reduced the price of fuel in April 2022, which effectively means that because we had that now added back in, it gave us an artificially inflated read for inflation for the month, as we would normally have as part of that particular story. So it's also important to understand that impacted the results negatively. When adjusting for the volatile items and holiday travel, the seasonally adjusted indicator showed a 6.5% increase in annual terms, down from the 6.9% recorded in March, and down from the peak of 7.3% recorded in December. The seasonally adjusted indicator rose by 0.2% over the month of April, which was the slowest monthly growth rate since July of 2021. So when you look inside the data, the trend overall is showing that the broader data is looking better and it's trending in the right direction. And so hopefully we can maintain the range and not have inflation remaining too sticky in that sort of 4 to 5% range. It's where we have concern. We've got to get it back down into that 2 to 3% range. Now, the mixed signals take on more meaning when you look at the annual trimmed mean measure, which is the core inflation, which dampens out the impact of bigger price movements. Core inflation increased to 6.7% in April from 6.5% in March, and that's not the good reading. So that's the mixed signals that we're seeing there. So looking into some of the different segments, what did we see? So housing was plus 8.9%, food and non-alcohol beverages was plus 7.9%, and transport was plus 7.1%. And they obviously continued to the largest contribution of the inflation level that we see at the moment. Plus prices for holiday travel and accommodation also increased over the April Easter break and school holidays break. So again, we continue to keep spending on these items, which is making the RBA's jobs harder of keeping interest rates where they are. In terms of taking a closer look at the housing inflation story, which is on the good news side of things, continues to ease from the peak recorded last year. So the component or mix in shifting, with rents accelerating at 6.1% in annual terms, the strongest pace going back to 2017, whilst the cost of new dwellings continues to moderate. So when we are looking at inflation, what we do see is we've got this challenge around rents, which are now looking to like they're going to go into double-digit inflationary levels over the course of the next 6 to 12 months. But what's moderating that is the cost of new home building is coming down. And that obviously means that that's sort of counterbalancing itself. So it really is quite an interesting time, because we've got to also remember that about 1/6 of the CPI basket is made up of the housing story. So that higher rents are going to continue to put inflationary pressure on the upside. So it really is going to come down to new home prices. It doesn't use existing home prices. So new home dwelling purchases and the cost of those materials is going to obviously hopefully drive down and counterbalance the rise that we're seeing in regards to increased rents, which we anticipate is going to happen at least over the next 6 to 12 months. Moving on to the labour force data now, and the big news, which I flagged earlier, is about the evolving higher wage risk to inflation, that wage price spiral stuff we were talking about. So let's take a closer look by looking at a big decision that was made by the Fair Work Commission. So last Friday, the Fair Work Commission, which is independent of any government, delivered its 2023-2024 minimum wage decision, which gives around 2.6 million persons on a minimum wage or award or enterprise agreement tied to an award, yes, it's complex, a 5.75% increase in their wages from 1 July, so this year. Now, this is on the back of a 5.2% increase for the minimum wage and a 4.6% rise from the award wages. So it's quite a complex wage system that we have here in Australia, but that is a significant lift in terms of the minimum wages for those people. Now, a smaller cohort wage group, some 80,000 workers, got an 8.6% increase from the Fair Work, taking their increased hourly rate from $21.38 to $23.23 per hour. Whilst this decision is great news for around 1 in 5 workers, the decision was higher than was factored into the federal budget by Treasury. They had the reading of around 5.4% increase in the federal budget papers. So the Fair Work's decision, in their view, was justified by the lack of growth in minimum wages over the past decade. However, there is a challenge. The decision is unfortunately inflationary. So, we've got these higher input costs often getting passed through to consumers if consumers continue to keep spending. So a decision such as this makes the RBA's job harder to bring down stubborn inflation. Furthermore, a decision like this encourages unions and other employee groups to call for higher incomes all round. Now, the real problem with this, and it's the problem I told you that was playing out in the UK currently, is that workers then go on strike for higher wages or to save their jobs, and the economy is tanking, inflation is skyrocketing, and that's what the dangers that we see in terms of the economic effect of a wage price spiral, which is sort of playing out in the UK at the moment. Now, the Federal Labor Party, in terms of delivering a sensible budget last month, with modest cost of living support increases, did a good job in terms of making sure that it was not inflationary whilst helping the most vulnerable in our community. However, we've now got a section of the Labor Party led by Tony Burke and his union allies that's threatening to undermine the fiscal policy restraints needed to help the RBA with its monetary policy agenda. So if we've got fiscal policy where the government's looking for more wages and more spending, and monetary policy looking to do the counter to that, we wind up in a really difficult position. So it's now more harder for the RBA to roll out their plans in trying to bring down inflation back to 2 to 3%. So that is obviously a real challenge. So the reality we've got here is the political pressure for obviously trying to increase wages, and Labor is trying to do that for its base. So that makes sense. But whilst Tony Burke and those members of the Labor Party who do that, there's a real problem here, because those higher wages above, say, 4.5% increases will unfortunately lead to higher inflation, which will obviously lead to higher interest rates, or interest rates staying higher for longer. So that ultimately doesn't really help anyone, because it causes an overall economic slowdown further than we had to have. So that is the message that I have here. So that's understandable that they would be advocating for that, but we also need to put it into context that this is a very challenging situation and they're counterbalancing each other. And so that's also going to be problematic for the RBA, which I mentioned. So in addition to that, I want to expand on a point here around that higher inflation, unfortunately, also, some would argue, helps higher wage earners. So our really high income earners get a benefit from inflation. Let me explain. So when there's really high inflation, but high income earners aren't impacted by interest rates, what they get is effectively their cost of debt becomes lower, because inflation makes debt lower over time. In addition to that, from an asset point of view, replacement costs become higher. So these people who own assets like property, it actually does a bit of heavy lifting in terms of increasing the value of property as well. So that's why it's important to understand. So for the likes of Tony Burke and the union affiliates, they need to consider that and be really careful about what they wish for, because the unintended consequences of these higher wages is going to also mean that it's going to increase the wage price spiral challenges that we've got here. So I want to acknowledge that for those folks who are doing it tough, this is a welcome addition to their households. I completely respect that. I don't want to lose sight of that. But I think, what we do need to understand is, these challenges are going to play out in a difficult way. And then you start to think about it from the small businesses and the businesses that employ these people now that those minimum wages are going up. So when we're talking about, cafes, restaurants, hospitality, retail, leisure sectors, those bulk in minimum wages will ultimately mean that there'll probably be less hours worked, there'll be less people employed casually, and there'll be more work needed to be done by those people who are left to do the work, because ultimately those businesses won't be able to pass on those costs, especially if consumers start to say, that's it, we're completely tapped out and we're not going to be spending money. So that does make it quite challenging. Now, when we do look at the wage price index data, what did we learn from last month? So we did see the wage price index increase by 0.8 of 1% over the March quarter to be 3.7% in annual terms. The WPI has now grown at a quarterly rate of 0.8 over the past 2 quarters, consistent with annual wage growth of around 3.4%. So we're not necessarily seeing the wage price spiral showing up just yet in terms of these wage price indexes, but its potential and the risk is coming. So while the quarterly aggregate rate has stayed unchanged, the mix is shifting. We are seeing higher public sector wage growth as more enterprise agreements are negotiated, yet in the private sector, growth is moderated due to a slowing in labour demand on the back of a slowing consumer spending, increased supply in the labour force for people looking for work, including the new immigrants and migrants who have arrived here. So outside the surprised increase announced by the minimum wages increase, quarterly growth has averaged at 0.8 of 1% over the past year, much lower than the rates recorded overseas and relatively subdued compared to historical data. Now, that said, I want to highlight that the RBA is making it really clear that they want to see wage growth connected to productivity increases because productivity puts downward pressure on inflation. So let me make that crystal clear. Wage growth is good, and I'm all for wages growth when there is productivity growth. That's a win-win-win outcome. Higher pay, better business performance, and lower inflation. And it's not so good when you're seeing just higher wages, no increase in productivity, and ultimately it just means businesses pass on those costs. So it doesn't work well. So we've got to make sure that wages are aligned with productivity growth in this country. And that is a significant challenge, as I mentioned, because over the last 3 or 4 years, we've really seen productivity flatline and the labour input cost increase significantly. So that is a challenge that we'll have to overcome for our economy. All right, that has been a big and pretty heavy conversation that we just went through. Let's actually now look at the unemployment data and see what we learned. So as we all know, the labour market has been performing very well, and we did see a surge in labour supply from overseas arrivals, and that has been soaked up in terms of the pent-up demand for workers. However, it appears that we have now reached what we call a turning point, whereby the ability to soak up new supply appears to be waning. So employment declined by just 4,300 jobs in April. However, the underlying trend is more significant and tells us more of an interesting story. So over the 6 months to April, employment growth averaged 25,000 per month, significantly slower than the same period last year, where jobs growth averaged around 110,000 per month. In other words, the momentum is softening as labour demand cools. Now, whilst new labour demand cools, labour supply is just hitting its straps. Surging overseas arrivals are driving strong growth in the available working age population and the overall size of the labour force. So stay with me, folks, as I try and explain this. So the number of people in the labour force was net 14,100. Now that's an increase over the month. Now we lost 4,300 jobs. So that's the number of unemployed people. That's what it increased by. So the net result there in terms of the overall size of more people arriving looking for work and the people losing the jobs increased by 18,400. So this resulted in an increase in the unemployment rate from 3.5% to 3.7%. Now, this is still reflective of a labour market that is exceptionally tight, but starting to ease, and the economy is intentionally slowed by the monetary policy decisions being made by the RBA. Now, further insights into this data, then we see the ongoing strength in the number of hours worked suggests that demand for labour is being partially met by people working more hours, so doing more with less. Is that approach as businesses start to shy away from adding more headcount, given the economic clouds that are gathering. Now, finally, on the labour force story, we want to talk about what's happening with job ads. And we saw a fall of 0.3% in April, according to the ANZ Indeed measure. The measure has now declined for 3 consecutive months. In annual terms, job ads were down 5.4% in April. However, despite the falls, job ads are coming off very elevated levels as labour market has remained tight through this current growth cycle. So we are starting to see the shift, that momentum move when it comes to the labour force and employment and unemployment in this particular space. So we'll see how that plays out over the next 3 to 6 months. Right, turning our attentions now to consumer sentiment data. And we saw that the Westpac Melbourne Institute Consumer Sentiment Index in Australia plummeted by a significant 7.9% in May, reaching a reading of 79, and far surpassed market expectations of a decrease of 1.7%. The index now stands just below the low levels observed in March, which recorded the lowest monthly read since the COVID outbreak in 2020, following the surprise rate hike that we saw in May. And a mildly disappointing budget is what is driving that sentiment story. Now, the gauge for finances compared to a year ago dropped by 10% to a reading of 63, whilst finances next 12 months, another sub-index, fell by 10.2% to a reading of 85.8. The economy next 12 months sub-index witnessed a 9.5% decrease in its reading to a 77.3. And the economy next 5 year sub-index declined by 9.2%, returning to the previous lows observed in November with a reading of 87.2. Now, the sub-indexes for the property nuts and gurus around the joint is the indexes that we look at. So what do we see from purchasing a major house item only dipped by negative 0.4 to a reading of 81.7. And the property stuff that I was talking about, a time to buy a dwelling, increased by 7.4% to a reading of 76.3. And the house price expectation index jumped another 10.7% to a very strong reading of 144.3, which is 18.8% up over the year. So as much as it's time to buy versus property prices growing, there's a mindset out there that property prices are going to keep growing. And that's showing up in the data. Remembering that readings above 100, optimistic, readings below 100, more pessimistic outlooks from those people in that survey. That's a good segue into obviously talking about our business data now. So let's look at retail sales and consumer spending. So retail sales trade was flat over the month of April. Only two categories recorded increases: clothing, footwear, and personal accessories. The department stores, it was reported these categories were boosted by spending on winter clothing in response to cooler than average weather. On a per capita basis, spending has fallen by 1.3% over the past 6 months, the sharpest fall since early 2008 outside of the COVID data. Now this has been declining, so back to levels recorded in July. In other words, individuals are spending the same amount as they did in the middle of last year. Now, given elevated inflation, this means that individuals are buying a smaller number of items than they did last year, and it confirms that the slowdown in spending has now extended beyond the March quarter. So we're seeing all of the key indicators working in favour of that manufactured economic slowdown. So even when you factor in the huge surge in immigration, total spending has not grown over the past 6 months. It's now back to its levels in October, meaning that once the cycle also factors in inflation, the volume of spending is officially going backwards. Now, by design, the higher interest rates, households and adjusting spending levels over the past 6 months, retail sales, excluding food and cafes, restaurants takeaway, has fallen by 2.3%. Now, notwithstanding the growing population, spending on food, -0.1, cafes and restaurants and takeaways, -0.2, declined for the first time since February of 2022 and December 2023, respectively. It's finally happening. We're seeing less spending. In terms of the business data story, business condition declined by 2 points to a reading of +14 index in April, but remained well above the long-term average. There was a third consecutive monthly decline in conditions, which are now well off the peaks recorded late last year of a +25 in September, but still elevated in a sign conditions overall are still particularly good. That's why they're passing on prices, people. In terms of confidence, increased by a reading of 0.1, but remained subdued at a reading of 0, suggesting that there is an equal number of optimists and pessimists. Confidence bounced back in the wholesale sector with smaller gains recorded in finance, business, property and retail. Trading conditions and profitability declined whilst employment conditions remained steady. Leading indicators also eased with forward orders down 2 points to below its long run average. CapEx also fell by 2 points to remain above its long run average. Capacity utilisation was steady at an elevated level. Quarterly growth in final product prices and retail prices continue to ease, which is good news for inflation. Finally, product pricing grew by 1.1% in the quarterly terms from 1.3% in March, and retail prices grew by 1.4% from 1.7% last March, which is also good news. What's important here is that what has occurred despite quarterly growth in some costs accelerating, growth in labour costs were unchanged at 1.9%, while growth in purchase costs increased to 2.3% from 1.9%. So we're still seeing some of those input costs also heading in the wrong direction. So what does this mean as we start, this turning point in businesses? We've got to continually convince them that they can't fully pass on their higher costs to consumers. And we hope, that folks continue to keep reducing their spending and keep their money in their digital wallets. And in other hopefully good news on the business side of the inflation story, we saw some good data come out in regards to private capital expenditure space. Let me explain. New private capital expenditure, i.e. CapEx, jumped 2.4% in the March quarter. The December quarter was revised up to a reading of 3% from the initial estimate of 2.2%. Investment in machinery and equipment jumped 3.7% over the quarter, while new building new buildings increased by 1.3%. Now, this is the important thing. Whilst the volume of investment grew strongly, the actual dollar value invested slowed. So let me repeat that. The dollar value, meaning the price paid for these investment goods, are showing signs of de-acceleration, right? So deceleration. Over the quarter, the price of investment goods increased by 0.5%, the slowest rate since March quarter of 2021, and significantly lower than the average rate of 2.2% recorded over the past 6 quarters. So what does this mean? Well, it suggests that the spike in prices being paid by businesses for machinery, etc., is falling as supply chain bottlenecks have resolved themselves and disinflation is moving through to cheaper machinery costs and starting to appear in terms of those prices. Now, it is going to take a little bit of time for those machines to be put in place, that productivity to be then accessed, and ultimately the cost to start coming down. So we will start to see this benefit in terms of the lower cost of machinery and input goods, again helping with driving down inflation in 2023, second half of 2023 and into 2024. All right, that rounds out the economic update. Let's now talk about property. And we still have a fair bit to talk about because it's such a dynamic market at the moment in terms of what's happening in the property space. So let's unpack it. The value of new housing finance, excluding refinances, declined by 2.9% in April. The value of financing activity is now 31.5% below its peak in January of last year. It is worth also noting, however, that the monthly new housing lending commitments are still higher than at any point before the pandemic. Now, this is a result of both higher property prices post the pandemic and the recent stabilisation in housing demand. Now, we saw weakness in April was concentrated in owner-occupied borrowings, particularly for construction of new dwellings, which fell 7.7% in the month. Borrowings for new dwelling construction is around 65% below its peak and is back around pre-COVID levels. So remember, in COVID, we have the building boom, the home builder incentives, that's all washed out. So we're now starting to get back to more normal times. In terms of investor lending, also declined in the April data, but since February, it remains 2.5% up. Now, this is most likely the result of a lag in investment property completions rather than significant bounce in new investment activity. So we're not seeing very many new investors jumping into the market, but those investors who might have bought off the plan or house and land package, those properties are now getting their certificate of currency, and ultimately those loans are now settling, and that's starting to show up in the data. Building approvals. This is a mess. So new residential dwelling approvals declined by 8.1% in April. Approvals are now 50% lower than the cycle peak of 2021 March, and are at their lowest levels in over a decade, back to April of 2012. Approvals for private, medium and high density dwellings declined by 16.5% over April. They're now 60% lower than their peak and are at their lowest levels since January of 2012. Approvals for private detached houses declined by 3.8% to be almost 20% lower than a year ago. Approvals across all states are significantly below the levels recorded a year ago. There is also serious deterioration in housing supply when we are desperate for more supply on the back of this record population growth stories. In addition to that, we're seeing state governments like Victoria and Queensland are scaring off investors with attempted tax grabs, which is only going to cause greater risk of future supply. So labour supply shortages are also causing delays or are putting some projects in jeopardy. And through the mix, and throw into the mix, I should say, APRA's decision to continue to throttle the lending market via their over-conservative buffer rate policy for lenders, and you have the perfect storm that we're seeing play out in regards to supply. it's really clear that new supply is drying up and completions are falling over. And we saw that in the December quarter data with almost 2% of those completions are down 2% since December. Now, whilst completion rates are coming down and likely to decline further, we have seen net overseas arrivals continue to power ahead. In fact, overseas arrivals and additional number of workers per age of population is at record levels, suggesting that the imbalance will only get worse before it gets better. So we're going to have high demand, low supply. So let's go back and look at a bit of history. And we saw the St. George Bank economic team look at an example of recent history where they looked at the mining boom investment, which drove a surge in population during that time. So we're talking 2008, 2009, when we saw around 300,000 people arrive at that particular time. Now, that was whilst the RBA was cutting the cash rate in response to the global financial crisis. But the context here is it still took more than 3 years for significant new supply to come online. So that's the challenge we're seeing the government facing and also, consumers facing, is that all of the policy settings are in the wrong direction for incentivizing investment. You're not seeing APRA reduce the buffer rates. You're not seeing incentive for investors to go in there and help increase supply. And that's the reason for that is that the RBA don't want to accelerate the inflation challenge that they're currently dealing with. So it's really, really a difficult time when you're thinking about supply side. But when you're thinking about demand side, and if you're putting your investor hat on, you're actually starting to think that there's going to be this extreme weakness in approvals, extreme weakness in residential construction, and it's going to make demand softer, supply softer, but demand is going to be growing over the coming years. Now that bodes well for a pretty good property story, which I'm going to talk to in a moment. So let's have a look now at the values that we saw through the home value index released by CoreLogic for the May. And we saw that the National Home Value Index, the HVI, has recorded a third consecutive monthly rise, with the pace of growth accelerating, which I have to say is even surprising me, which I mentioned at the start, about the pace of growth that we're seeing. So we saw prices increase sharply by 1.2% in May. After finding a floor in February, home values are now increased 0.6 and 0.5 through March and April respectively, followed by that significant 1.2% in May. So let's take a look at the numbers. Sydney, 1.8% for the month, 4.5 for the quarter. Melbourne, 0.9 for the month, 1.6 for the quarter. Brisbane, 1.4 for the month, 1.8 for the quarter. Adelaide, 0.9 for the month, 1.1 for the quarter. Perth, 1.3% for the month, 2.4 for the quarter. Hobart eked out a 0.5 increase for the month, but it's still negative 0.5 for the quarter. Darwin, 0.4 for the month, negative 1.3 for the quarter. Canberra, plus 0.4, but negative 0.1 for the quarter. So combined capitals, 1.4 for the month, for the quarter, 2.8. Combined regions, plus 0.5 for the month and plus 0.8 for the quarter. So at the start of this update, I promised to talk and go deeper into what's driving property prices and what's also making these property prices grow quicker than I expected them to. So let's break that down first in terms of what's driving property prices. Well, it's really simple that we can see that demand is increasing and supply has restricted. And we all know that in the short term, what drives property values is demand and supply. So that's number one. Now, how do I explain that in more detail? Well, as a property cycle moves through its phase of growth and it runs out of steam, effectively the cause of that was the interest rate movements, which then changed sentiment and also that affordability story. So we've moved through that phase, higher interest rates, and that basically pulls out the sentiment and confidence, which effectively pulls out the buyers. And what you're left with usually is still a reasonable amount of supply because the sellers didn't expect the buyers to leave the market so quickly. So there's an amount of property that's still available that needs to be absorbed, or the seller decides to pull that particular property off the market, or they accept the prices. And so that means that they need to reset their expectations around the price they'll accept for that property, and usually it's lower, and that's why we see the downward pressure on prices as part of that cycle. So that is the fundamental reason why we're effectively seeing right now supply has come down significantly, demand has increased as there's a section of the market who feels like we're reaching the top of the cash rate cycle. So they've decided to come back into the market en masse, and that's creating this little mini FOMO episode. We're seeing it out in the marketplace ourselves, where there is definitely enough buyers out there. Now, what you need to understand there is with higher interest rates, it still doesn't knock out all of the main buyers, right? So what I'm saying there is there still might be as many as 40% of households that can comfortably afford interest rates in the 6% range, as opposed to the 60% or the 100% that could afford borrowing money when the cash rate was, or the retail rates that we were paying in terms of interest rates were around 2%. So that's what we've washed out. But we still have enough demand from those buyers. And those buyers became impatient based on the idea that property prices and supply started to reduce, which meant that they either wanted to get on with their lives and decided to make the decision to buy. And that's this little mini FOMO message and story that we're seeing playing out in the behaviour of buyers at the moment. There's a limited amount of stock and there's enough buyers, and that's what's driving property prices. So in short, the reason why property prices are moving at the moment is that there is enough demand to meet the current level of supply. So that closes out why property prices are growing now. In terms of why are they growing at the level at which is surprising me, well, you need to then take a deeper look into the data and you start to learn what happens in these types of cycles. So the first thing you'll learn is that even in a new cycle, it's usually the top 25%, so the top quartile of higher value properties usually start the growth cycle. And interestingly, at the end of the previous growth cycle, they are the properties that usually give up the most value. Okay, so they grow the fastest and the highest, but they are more volatile and they potentially give up the most in terms of percentage when the marketplace corrects itself. They still do beautifully in terms of going higher for longer, but basically that's what's happening. So when you can understand that, you then want to understand basically, well, what is CoreLogic's home price index actually measuring? And this is where we get into a better understanding. So what the home value index is measuring is effectively, it's not measuring median price change. It's not measuring the average price change. In fact, what they're trying to do with this method is address the issue of that, what we call compositional bias associated with using just things like median values or average price values as our measure. Instead, the CoreLogic Daily Value Index is based on a hedonic regression methodology, which includes the attributes of properties that are transactions as part of the analysis. And then they flow that right throughout the entire Australian property market. Now, this is what we need to understand. So effectively what they're doing is they're using factors such as the number of bedrooms, the number of bathrooms, the land area, the geographic content of the property, and that allows them to measure a much more accurate analysis of the true value movement across specific housing markets. Now, this method also allows for compositional change in consumer buying patterns when measuring capital gains. Now, the index, as a result, is related to daily movements in Sydney, Melbourne, Brisbane, including the Gold Coast, Adelaide and Perth, and the combined capitals, which is the composite of the capital cities in which they measure. So what they are measuring is the capital growth measurement for all dwellings, which includes both houses and units, in the data that they report and obviously in the results that I share in this particular update. So what's important to then understand is what is going to move that value the most. Well, it sort of becomes logical then to think that if it is the higher quartile of properties, then it's going to naturally inflate the growth performance. So in other words, if the really high values of property are being sold at higher levels again, that is going to flow into the data, and that's going to make the overall percentage gain look like it's a higher return across the market. So that's what's happening. And we've got proof of that because as we saw through Tim Lawless's update, and so he is the CoreLogic's research director and a good friend of the Property Couch and myself, and he noted the same thing, that he's reporting that the premium end of the market is driving the price rebound. Now, the premium end of the market, based on his analysis, has gained 5.6% over the past 3 months compared to only 2.6% rise in the more affordable lower quartile. Now, that's not forgetting that also the upper quartile, again, as I said, fell the most during the cycle. So what he also then goes on to say is that the amount that it has fallen in the cycle, there's still negative 11.8% below its January peak. So that upper quartile still has 11.8% of that peak before it gets back into record price territories. So there's still a bit of gain to be had there in terms of that. Now, that is obviously what we're seeing here. And as I mentioned earlier, there is people who have very high incomes, and the interest rate story at interest rates at 6 or 7%, it really isn't affecting them. They can continue to go on their buying spree. Now, we don't know roughly what proportion of the population that is, but it's pretty clear in terms of the activity that we're seeing out there that it could be as many as 40% of the market that still have strong borrowing power and still have the ability to buy properties in these difficult times. Yet, if we looked at the media and looked at all of the affordability challenges, and we looked at average household income or median household incomes compared to obviously borrowing power, it doesn't look logical. But the reality is double household incomes, 2 professional couples, there are thousands, if not tens of thousands, or even hundreds of thousands of those couple compositions that we see around the country. And they're the people who are also playing an important role in terms of taking action now, and that's pushing property prices higher. So in conclusion, what am I saying? I'm saying that the reason why it's exceeded my expectation is really on the back of, well, it's not broadly spread across all quartiles. It's mainly the premium end of the market that's driving properties higher, which is affecting the percentage gain that we're seeing on a month-to-month basis reported by the CoreLogic Home Value Index. So that's a big takeaway, and you should always remember that. It's not a rising tide lifting all ships marketplace at the moment. That said, we are also seeing some strong competition at that affordability range, in that 400,000 to 600,000 range as well. There are some activity in that area from both first home buyers as well as investors that are also playing in that particular space as obviously rents start to increase. So we will expect that lower quartile to also start to perform reasonably well, subject to where interest rates go over the course of the next 3 to 6 months. So definitely some really, really positive buying opportunities that are available out there for those people who have taken action. It's also a really important point for me to remind those people that buying behaviour can change. I've been saying it, Bryce and I have been saying it for a long time. It can turn off quickly, it can turn on very quickly. And when they've been sitting on the fence for the past 6 to 9 months, that's what's happened now. So the smart money, smart investors, they got in earlier than February. We were telling people that's the best time to be greedy when others are fearful, and they are going to reap the rewards. Those people who didn't act, they're obviously now starting to pay a premium. The bottom has passed, and that is ultimately the story of their investment experience today. So that's my thesis in terms of why we're seeing an accelerated level of property increases that I wasn't expecting, but the logic is really clear about demand exceeding supply more generally, and that's why property prices are doing what they're doing. All right, so that's a big update in terms of the property side. It's been a mega update overall, and there is a reason for that. I will not be doing a July update. I will be overseas on a study tour in the US, so I won't be producing an economic and RBA update for July. So for those people, if you're wondering where it is, if you're listening to this now at a later time, that is the reason. I will be overseas studying. So I just want to obviously make sure that we cover off on the key takeaways from this mega update. The first one is what we're talking about when it comes to wages and productivity. It's a real challenge. The RBA are going to put a lot of pressure on that. They do not want to see a wage price spiral, and so that really is going to be a key takeaway. Sticky inflation is going to obviously be the other critical point in terms of them trying to, tread this narrow path and trying to get the balance right. That becomes more difficult if interest rates continue to keep rising. We're definitely going to see, if they do, a more damaging economic slowdown and a slower recovery out of that for many people, and obviously higher unemployment as part of that particular story. When it comes to your own personal cash flow, another important reminder and an update for you, you do need to understand money in, money out at these particular times, even if you have really significant buffers in terms of what runoff are you having on those buffers. So I do remind everyone we have a completely free tool that's built into our More platform called Money Stretch. It's designed to help you work out just exactly how far your money will last you in terms of months and years based on your household budget. So I'm putting a link on this page to an introductory video and tutorial demo that I've shot in regards to that. If you're listening to this in audio via our podcast, that link will also be in the show description for you as well. Now, in terms of property prices, where are they going? It's still going to be a story of interest rates. So where we currently sit, I still see demand exceeding supply. There's still enough people with high enough incomes that are active in the property market to see that happen. The length of time in which interest rates remain higher is going to be it's going to play out in terms of property prices. Will they slow down from their current speed, and will they plateau? I think that's probably a sensible assessment if interest rates remain higher for longer. But I want to stress this point, that as soon as interest rates start coming down, make no mistake, property prices will increase, and it will be a story of the rising tide lifting all ships again, and you're going to see some pretty quick growth and some pace back up to where that affordability measure continues to tap out, and then you'll see an easing of values. But we're going to be going through this cycle, and it's going to be an interesting longer cycle in the event that interest rates will eventually come down, because eventually inflation will be kept under control. All going well, the government doing what they need to do from a fiscal policy point of view, and obviously the RBA doing what they need to do from a monetary policy point of view, because once we come out of this story, the supply story is going to be shocking. Rents are going to be obviously a lot higher, so that's also going to play out as well. So if you're a property investor, that is going to be good news for you over the medium to longer term in terms of what's actually happening there. And just on that final point, if it's becoming harder for you to hold properties, I've given you those tips in terms of making sure that if you can hold on to all of your properties, you're going to be well rewarded by doing so. So if you're thinking, or if you're panicking and do a knee-jerk reaction of selling one of your properties, I hope you don't regret it. So that's my view from a financial point of view. Remember, I understand personal situations are yours and yours only. I'm just talking about where you'll get a significant financial reward for taking on what will be a little bit of economic and financial hardship to be able to manage through that period. But it's a key takeaway, and that's why I wanted to double click on it today to make sure that you understand. Do whatever you can to hold your owner-occupied home and any investment properties that you have, because that will ultimately deliver you well over the medium to longer term. So again, reminder, I'll be back in August. I'm taking a break for July overseas on that study tour I mentioned. And so I always want to remind everyone that knowledge is empowering, but only if you act on it. Thank you for staying as long as you have through this very, very long update. I will be reviewing how I do these updates in the future to try and reduce their size. But until next time, bye for now. And again, remember, knowledge is empowering, but only if you act on it.